What's up, guys? It's Devin Burr, Mr. Burr. Thank you for stopping back into my YouTube channel. I am here with my new friend, Chris Kirkpatrick.
What's up, guys?
And I'm really excited to be here, guys. I actually learned a lot from Chris when I started learning about infinite banking. And we're in his studio right now, and we are gonna talk about how I bought my Audi R8, 2020 R8, and actually make money doing it. And it's gonna blow your guys' mind. So go ahead and stay tuned. And if you haven't already, hit the subscribe and smash that like button so you can get more of these videos when I put them out.
Hey, what's going on, Cash Flow Hackers? It's Chris with Life 180, and I'm here with my buddy Devin Burr, Mr. Burr from TikTok. He's doing some stuff on YouTube now. Today, we're gonna be talking about how to buy your car the best way possible. This is, I think, gonna blow your mind. Me and Devin just sat through here. He just bought an Audi R8, right?
Audi R8.
Audi R8, $206,000, and we were basically walking through how he bought it. I got it sketched out on the board right here. We just went through all the numbers. We went through his whole process about how he bought it and how he's actually going to wind up getting this car for under 100 grand, which is actually, ultimately, we'll get into it, but you're gonna get it for free, effectively.
I mean,
in a way.
I'm technically gonna make money buying it.
Which is nuts. So listen, I know that sounds like hype. I know it sounds like, almost too good to be true, but I promise you it's not. So here's the deal. Let's get into it. I think one of the things to be able to understand this is to be able to figure out, okay, there are different ways we can all buy cars, right? We can go pay cash for them. We could finance them through a bank, through whatever the dealership or whatever it is. Go get your own credit union or whatever it is. I don't know if a credit union is going to loan you money for a supercar, but let's assume they would. And then we could do it the way you did it. Right?
Or you could steal it.
You could steal it.
Don't suggest doing that.
I wouldn't suggest. I have a guy I know in high school that stole a car. He's in jail still. So don't do that.
Yeah, don't do that.
So all right, let's talk about this. So I'm gonna hop to the board here. Check this out, guys. So you can see here we have the best way to buy a car, right? Now, I want to focus first and foremost on cash, right? The idea, talk to me, Devin, why do you think people pay cash for a car?
I think most people, they hear Dave Ramsey, right, saying never finance things, pay cash for everything. So for a lot of people that kind of makes sense because people don't want to have an interest expense that goes to the bank, right? So on this kind of car, it would be 6% interest over 6 years, ends up being almost $40,000 in interest. Mm-hmm. So people, they buy cars cash so they don't pay interest to the bank. Makes sense.
Yeah.
Right?
Yeah.
They don't want the payment. The payment would be $3,400 a month.
Yep.
So they pay cash to avoid the payment and to avoid the interest getting paid to somebody else. Makes sense, right?
Totally.
However, when they do that, that 206, they can no longer make money off it. It's called opportunity cost. You actually lose $450,000 in opportunity costs, what that money could have earned you over your lifetime.
Yeah.
We calculated this based on me. I'm 37.
Yep.
If I lived till 80, which is the average life expectancy, that's 43 years, that's how much that 206 would have grown with opportunity cost. So paying cash makes sense on a surface level because you don't pay the interest and you don't have the payment. But you're giving up $450,000 by paying cash.
Boom. Yeah, so I think the key way to understand this, when you spend $1, because let's face it, when you buy the car, you're spending the money.
Yep.
When you spend $1, you don't just lose that money, you lose what that money could earn you for the rest of your life. That is the simple definition of opportunity cost. Yep. And so that is what this is. And so the idea here at 206, people, hey, you add in the 206 and 39, 245, why have this extra expense of interest? Well, it's because if you could have that money working for you in another account, you trying to save that almost $40,000 is going to cost you $450,000. I don't know anybody with any financial savvy in the world that's going to think that that's the way to go. Right? So let's take it to the next level. Now, by the way, this is what Dave Ramsey would say that you should go do. Right? He would say go pay cash. If you can't afford cash, you can't afford it. Right? Whereas Robert Kiyosaki and people like him would have a completely different way of handling it. Now, so let's talk about the traditional way of buying a car. You looked at this.
Yep.
Right? And if that were the best way to do it, you probably would have done it.
Right.
Right? So let's talk about what that experience would look like, because you went through this process. So walk me through what the numbers look like from a traditional financing perspective for a supercar. Full transparency, I'm a Jeep guy. I would never buy a supercar, but he's like, this thing is sick.
So what I did, guys, is I basically went to a bank and figured out what I would have to pay them if I financed the car. Because at the end of the day, like, I am my own bank. That's what I talk about. So what Chris talks about is becoming the bank by using a specially designed and engineered whole life insurance policy. So since I'm the bank, I want to figure out what the actual bank, Chase, Wells Fargo, Bank of America, what they would have charged me to buy the car. So what it was, where's this at? Oh,
it's right there.
It's 6% interest over 6 years.
There we go.
Yep, so 6% interest over 6 years is $3,400. So I can write on this thing?
You can. Yeah.
Guys, this is blown my mind. Before we got on this, I am blown away by this board. I know where my next tax write-off's coming from.
Exactly.
So it's $3,400 a month for 6 years at 6% interest to buy the $206,000 car. Now the insurance on the car is $840. That's for full coverage, right?
It's a supercar.
It's a supercar. It's going to be expensive insurance. Now, I just put a video out on YouTube and TikTok talking about how I bought the car and I'll make $70,000 just by buying it. However,
this is awesome. We just figured this out, by the way. It's awesome.
However, I will actually make more because I didn't take into account that I actually self-insure the car through my policies. So think about this, guys. $840 a month is the insurance cost. The most expensive part of insurance is the comprehensive and collision.
Yep.
The liability coverage is only $40 a month. So you have to have liability on a car. Since I don't have an auto loan, since I'm buying it from my policy, I don't have a bank loan, I don't need that comprehensive and collision. However, it makes sense to have it, so why don't I have that come from my policy? So that $800 is no longer going to a insurance company for the car.
Right.
I'm recapturing that money, okay?
And you're self-insuring because of the fact that the loan that you used to buy the car was through your policy, right? You technically don't have a loan for the car. You are self-financing that car effectively because that policy loan is guaranteed by the cash value in your life insurance policy. So because of that, and I just want to make this abundantly clear to people, because of that fact, you don't have to have insurance. You don't legally have to have insurance. And you're basically saying you decided to take the risk, right, of that $800 a month, self-insuring. So what happens? Let me ask you this. What's the plan? Just play devil's advocate. What happens if you wrap that car around something?
Great question. Great question. So here's the thing. The $800 a month, because the liability portion of the insurance is only $40. That covers if I run into somebody else, right? That $40 a month I have on the car. So the other $800, I just put it into my policy. And if anything ever happens, mind you, I haven't been in a wreck since I was 17. The likelihood of me getting in another wreck is pretty low. I drive like a grandpa, even though I have an R8.
Okay.
So that $800 a month goes into my policy.
That's a whole different conversation, by the way.
So the $800 a month goes into my policy.
Okay.
If anything ever happened, it's my fault.
Yeah.
I just use my policy to repair the car.
And you have, so full transparency for everybody, you have more money in the policy. You didn't borrow and maximize a policy. You have more cash there, so you can self-insure.
Correct.
If you total the car, you've got the money there.
Correct.
Maybe you decide to write it off. Maybe you'd put the money into it. You don't know yet at this moment. You'd evaluate that. But we talk about this all the time. It's about control, right? It's about the control to be able to make decisions in what's best for you in that moment.
Right. And it takes time to get to those things. Like you're not going to do everything from a policy your first year, right? Unless you're dumping in millions of dollars. Most people can't do that. So over time, you can start taking back the function of banking in your life. Whether it's insuring a car, whether it's buying a car, whether it's buying a house, whether it's buying a boat, whatever it might be.
Yeah.
So the way this worked out is if I bought it on traditional financing, $34.14 a month plus $840, the outgo would be $42.54 per month. So over 6 years, I'm paying just over $306,000 to own the car. Mm-hmm. That's how most people would buy the car, right?
Yeah, yeah.
Or they'd steal it, which they'd be in prison, and they wouldn't want to drop the
You'd get it
soap.
for a couple days if you did that. So here's the deal. They have this $306,000 is what the outflow of money is out of their pocket for the policy. So now these are the two ways that most people would buy a car, right? Traditional, cash. Dave Ramsey would say this. Other people would say do that. But this is why we love infinite banking so much, right? So you are able to basically take the money, you put it into a policy, right? So you have enough money in your policy. Let's utilize the same numbers. Let's say you're going to pay back the policy loan at the same rate, finance it over a 6-year period, even though the interest rate in your policy loan is going to be a little bit better than the auto loan.
Right.
Fair enough. So that's going to save you on some of that expense. But we're going to just put that money back in there and assume that that's pretty close to even. You're going to self-insure this, as we just talked about.
Yep.
So that's going to help increase your efficiency. Instead of $42.54 a month, you're going to have $34.40 a month. Is from a cash flow perspective, you're going to put that extra $800 back into the policy, but that's just going to re-increase what I call your collateral capacity, the amount that you have in the policy that you can leverage, whether
right.
and you're choosing to utilize that as a self-insurance component, right? So you are still going to have that liability, right? So here's the crazy part. That $800 a month over that 6-year period, if you don't get into an accident and your track record holds true, you've got an extra $57,600 in insurance costs that you save, that you have back in your pocket.
Yep.
That's like phenomenal.
And that's the thing, guys, is like insurance companies have all the money. They calculate risk, and because of that, they're not going to insure someone that isn't insurable, right? If you've got a bunch of wrecks and speeding tickets, your rates are going to be higher, right?
Yep.
Even if you don't have them, you still have to pay for it just in case. So over 6 years, I would have paid that much to an insurance company. And again, it goes to opportunity cost.
Right.
That money can no longer grow for me for the rest of my life.
Yep.
Right?
Totally.
So I'm recapturing what I used to pay to other people. Mm-hmm. It's coming back to my policy, my bank, my control.
Right. Yep. That's amazing. And so check this out. So we went through full transparency. We're not going to put up the illustration just from a privacy perspective and all that stuff. But when he took the policy loan out for the 206, he had $648,856 in cash value in the policy, right? Then by the time year 6 comes around, he's going to have cash value of $1,442,303. So here's the thing to understand with this. He is making premium payments along the while at about $125,000 a year, right? And so that's happening, but it's important to understand that all the while when he borrowed it, the 206, he had that. When the loan is paid off, he's going to have the $1.442 million. This grows by $793,447. Now, here's the deal. He's got a net injection into the policy, meaning this is how much he's contributed to the policy. And with that, he has also an interest expense charge, right? So like what you do here is you go 793 because that's what it grew by. You got to minus the injection, minus the interest expense. That leads to a net gain of 109,000. So this is how, like, think about this. Now, I want to say this. There's different ways to kind of like phrase this, right? So there are different ways that you can kind of look at this number. I look at this and I think this is where, personally, I think a lot of people kind of communicate this wrong in the insurance space that talk about this. And I'm not saying you say it wrong, but like I'm not looking at this as making $109,000 because it's kind of like I talk to my wife, right? Like she goes, Chris, it was on sale. Like how much money I saved. I'm like, you didn't save any money. You
still
went shopping.
money.
You still went shopping.
Yeah.
You're never going to make money and get rich by buying depreciating assets like a car, right? Like it's just not going to happen.
Right.
If you said, hey, Chris, I went out and I bought a cash flow real estate property, now we can have that conversation. But you bought a supercar, right? Like, so you're not getting rich, but let's face it, you were going to buy that supercar anyway.
Yep.
So if you're going to buy that supercar anyway, you might as well do it in the most efficient way possible.
100%.
That is what this is all about. And so in this instance, his net gain, when we talk about net gain, is like, if you're going to make this decision to buy this car anyway, do it in the most efficient way possible. This 109 means that's $109,000 that you're going to have more in your pocket than you would if you bought it any other way.
Yep.
Fair enough?
One thing I want to touch on, guys, is if you look at this, the difference between these numbers is about $800,000.
Yeah.
So it grows by about 800 grand,
Yeah.
right? 793,447 bucks.
Yep.
However, I used 206. So that's why the net injection is different. I put in so much over that time frame, but I used 206 of it. So the net injection is 628,000. The interest expense, and this isn't even really accurate because
Yeah.
I'm paying down the balance.
Yeah.
This is assuming, guys, I never paid the 206 down, which obviously I
Right.
do.
Right. So this is absolute worst case scenario.
Worst case, if
Worst
I
case
never
scenario.
paid
Yep.
back the policy loan.
Yep, that's amazing. And so think about it this way. So I gotta say, we just went through this because he just drove down. We're filming some content today, and as we're going through the numbers about how he bought this car and how he used the policy, and this is obviously what we both do, and we're running through these numbers, and we're like, oh my gosh, this is so awesome. But it gets better, right? Because here's the deal.
We're gonna touch on this.
You're gonna buy this car for 206. You basically 206. You're gonna have $109,000 in cash, basically extra because of the way you handled it all in your policy. So 206 minus 109, that's 95,000 bucks. So this is effectively saying you were able to buy this Audi R8 for under 100 grand. I don't know about you, but I might actually be interested now that I've seen this, like in getting a supercar just for fun, you know. But it gets better because what do you think the value of the R8 after 6 years?
So it's hard to say with inflation, but if you guys look at a 6-year-old Audi R8 now,
Yep.
they're anywhere from like $150,000 to $180,000. They hold their value really well. This one's gonna hold extremely well because it's a V10 and they don't make V10s anymore. So I would say worst case, it's worth $150,000 in 6 years. I can sell it, rinse and repeat, get another supercar.
So 150 plus 109, let's just do that. 259.
How'd you make these look all nice and
I have
proper?
no idea. Sometimes if you hold it long enough, it does it. Oh, look at that. Look at this. I'm just learning
I love this board.
I'm learning as we go here.
This is incredible.
So this is, I mean, think about this. This is insane. So you basically have net worth of 259 by the time this is all paid off, because you have it completely paid for. You got the extra $109,000 and you paid 206 for it. So your net gain is 53,000. So that is your pure, what you really, really actually were able to pull out of this thing.
Over 6 years by buying a car. Now, one thing I want to touch on, because I hear this all the time.
Yeah.
People are like, oh, well, you got all this money, you can do it. Guys, this will work for a Ford Focus,
Yeah.
a Pinto.
Perfect.
Like
It's
it'll
great.
work with anything. It's just compound interest. It's the money is never like this 206.
Yeah.
It never stops growing,
That
even
works
though
with-
I'm using it.
And that can work with $26,000. That can work with $30,000, $15,000, whatever it is. The best. These principles, I always success leaves clues, and the principles of this money stuff don't change. It doesn't matter. He's talking about a bigger level. I know I do the same thing when I'm talking about real estate and stuff of that nature. But the bottom line is you can scale this down, and the principles work at every level. Yep. That's why I did a video one point in time on my camping trailer, right? Because it was a $30,000 camping trailer. I rented it on Outdoorsy. I bought it because it was like great for my lifestyle, because my family and I love to go camping. My kids love it. But you know, also by utilizing a policy loan, instead of paying $30,000, I was able to talk the dealer for a cash sale for $19,900.
Yeah.
So I was able to basically pay 33% less for the trailer, and then I rented it on Outdoorsy. I cash flowed it 25% a year, and I was able to use it, and then I sold it for more than I paid for it. It was amazing, right?
Wow.
Like the same concept. And that guy's was at a much smaller level, right? That's a $20,000, right? We do
Still
it for
works.
real estate. He does it for supercars. I know you do real estate too, but like this concept works across the board at any level. The only mistake people that I see make is waiting too long. And my favorite, one of my favorite phrases is the best time to plant a tree is 30 years ago. Like, you wish you'd started this when you were 25.
Second best time
20,
is now.
Right? Second best time is now. And that's all I can say to this. And this concept, this principle, you know, it doesn't change no matter what you're talking about. And once again, I'm not going to try to say, even though in this instance, he did walk away, it looks like up 53,000. But here's what I also want to play devil's advocate on that one, is that's assuming $150,000 of resale value of that car.
Right.
So if that car goes down to it's only worth 100. I mean, that's an assumption that we're baking into that. Whereas most cars are not going to have that kind of value retention. So because of the type of car you bought.
And even if it did,
right.
let's say it went down by 53, it's worth 97 at that point.
Yeah, then
you still didn't lose any money buying a car over 6 years.
Right. And so at the end of the day, once again, this isn't about how do you make money on buying this car. It's if you're going to buy this car anyway.
What's the most efficient way?
You got to do it the most efficient way possible.
So this is very complex, guys. This is not like off the shelf how to use infinite banking.
Yeah.
But I like pulling off ninja moves. All right.
Totally.
Like I used to be a little like green belt when I was a kid, right?
Nice.
Little ninja moves
Attaboy.
with the gi and everything.
Yeah. Oh, way to go.
So, guys, I'm gonna throw another little ninja move in here for you.
Love it.
So a lot of people are gonna say, yeah, but you've got to have that $3,414.
Yeah.
You've got to have the amount for the insurance. Where is that money coming from? You're still spending the money. Get this, guys. I use infinite banking for cars. I use it for real estate. I use it for things at my house, big expenses. We're doing a wine cellar.
Yep.
I'm funding that. I'm the bank for that. What I did on this is I had an extra like $350,000 I lent on a real estate deal that pays me 12% interest.
Nice.
So that
Was it hard money? Was it private money?
Private money.
Okay, private money.
Okay.
Yep.
And I'm in first lien position. So if they miss a payment, guess what?
You get the property.
I get a house.
Yeah.
So I'm almost wishing they miss a payment. But
good.
bottom line is, guys, I have the money from the policy buying me the car, doing infinite banking using this. But I also have another 350 grand, give or take, working for me outside the policy, still earning compound interest in the policy, earning me interest outside of the policy on a deal that I control because I'm in first lien position.
Yeah.
That money comes in, that pays me back.
That's awesome. So when I use this phrase a lot, slow down to go fast, right? And I think it's one of the most important principles in business because sometimes we just try to get too much too quickly and that's what kind of blows things up on us. With our money, one of the greatest myths that I think is taught in the financial space is the younger you are, the more risk you can take.
Yeah.
Because it's financial structure. And by utilizing infinite banking as a foundational component, like a cornerstone asset in your finances, it forces you to slow down to go fast because this doesn't happen overnight. Like you said, you don't save up this amount of money overnight unless you are blessed, you got some sort of inheritance, maybe you launched a business and it just took off and you're sitting on all sorts of capital. Believe me, I know that happens. I talk to people all the time. I know you do too. Where that happens, but the bottom line is most of the time it's going to take time to build it up.
Right.
So slowing down to go fast is like once you are willing to save, but you save with the intent of investing and you have this long-term vision, you're not worried about chasing all these returns right out of the gate. You're worried about like, how do I build the structure so I can just have a launch pad, have rocket fuel to put into my system? Because once I do, now I can go out, I can get this car, I can have the rest of my assets fund my lifestyle all while it's growing at the same time. And that's what this system is all about. And I think that's what people miss when they don't see this and they don't get it. It doesn't make sense to them. Is that it's not about chasing bigger returns. It's about investing with intention, control of your capital, control of the assets, control on where your money's going, control on the type of cash flow. You know, that's what my book Cash Flow Hacking is all about, is how do you invest for cash flow, you know, to increase your lifestyle along the way. This whole idea that you got to work and grind for 40 years just to retire, hopefully, you know, whereas 95% of the people that get to retirement are not able to maintain their standard of living, that's a problem. You know, like you can have freedom, be completely financially independent if you follow this methodology. You can do that in 10 years. Devin has done it in 2.5, right? Like what, like 3 years ago, 4 years ago, you said you were all pretty much bankrupt.
6.
6 years ago.
Yeah.
So in 6 years, he's gone from, did you actually do bankruptcy?
Yep.
Okay. He went from being bankrupt 6 years ago to implementing this system, doing things, relearning everything he thought to be true about money turned out not to be true. And he relearned this system and he saw it and it made sense and it clicked and he started to implement it, right? And when he did, he's gone from being there in 6 years to now having a supercar, having another Audi SUV, custom building a house, traveling all over the world, doing all this stuff, and having a huge real estate money or real estate portfolio where now he has the ability to lend out and be the lender in the private money space.
Yep.
I don't know if that is clicking with you as you're watching this video, but to be able to go from bankrupt to there in 6 years is like, this is the only way it happens. I mean,
I would say the biggest thing is, and I had to learn this, guys, is helping other people.
yes, amen.
Like, I learned this concept 2.5 years ago. And when I learned it, I was like, this is incredible. I just took it and ran with it with real estate. I was just doing all my real estate deals with it.
Yeah.
And I thought it was incredible. So I'm telling everybody, everyone that would listen, I was telling them what I was doing.
Yeah.
And then when I got on social media and started sharing it with more people and helping more people, my income, my net worth, everything blew up.
Yep.
And I hear all the time is, why would you do this? The rate of return, and you touched on this, the rate of return is only, the guarantee is like 3.25.
Yeah.
But you're not seeing the big picture, guys. If that's what you're thinking, so think about this. Think about the money I lent out, okay? So I've got $350,000 that is lent out on a real estate deal, right? Now, this $350,000 is not lent out. It is in my policy, compounding and growing, tax-free. I'm borrowing against this money, okay? So this money actually makes me, let's say 5% in the policy with dividends, okay? That's pretty conservative, right? So if it makes me 5%, and then I get a loan from the insurance company for $350,000, and it costs me, let's say 5%, right, to borrow that money. Now I can take the money that they lent me, lend it out on a real estate deal where I make 12%. So think about what I'm making. I'm making 17% total, right? But it's only costing me 5%. That's over a 340% cash on cash return because my money is not being used. The insurance company is being used. So it costs me 5% to use their money to make 17%. I don't know an investment you can do that makes a 340% cash on cash return that doesn't have a ton of risk.
Yeah.
The only real risk is when I take the money and put it into the real estate deal. But
Totally.
I don't invest in things I don't know and understand. So I only take that money and put it into stuff I know.
And that's why I say, and this goes back to the comment before of slow down to go fast, is the first investment that you make shouldn't be in the car. Like, let's say you wanted it. You could actually, you're not going to do this, but you could take that Audi R8, you could cash flow it. You could put it on Turo or something like that and charge $800 a day for it. You know, something of that nature. You could, you're not going to. But this is why if you do real estate, if you do business, you do private money in a lot of different ways. But the bottom line is the first investment that you need to make is in yourself. And you do that by surrounding yourself with mentors, by getting into masterminds, by going to events, by learning a skill set and really understanding if you're going to do the real estate, really understand it inside out and make sure, because there are ways that you can do private money where you expose yourself to risk unnecessarily.
Right.
You just said it right out of the gate. You put yourself, you're in first lien position on this house. If they default, you get the property. So you're like completely galvanized, right? Like you're protected. If you didn't do it the right way, you know, you just tried to loan it to a friend and didn't have it, like you could be totally exposed, right? Like you got to know all the ins and outs, understand the markets that you're, you know, putting it into, understand, you know, what the project is all about. And if you're going to lend money for real estate, you better understand the real estate that you're lending it to, because if you are in first lien position and you know there's a chance that you will wind up with that property, you better make sure that it's a property that you even want to deal with. You know what I mean? If it happens. And I know it is for him because he already said, I hope they miss a payment so I get the property, right? Like, so I know that's the case, right? And so just understand the first investment that you need to make in is in yourself, in your own knowledge, in your own network, in your own growth. Build your skill sets, build that expertise. That way you don't have to run that rat race that most people are running.
Dude, it's incredible because I could not agree more. Like before, guys, I started investing in real estate. Before I did all that, I was on a like personal growth rampage.
Totally.
Like I was rock bottom, bankrupt,
Yep.
heartbroken, down to $300, couldn't afford the apartment my daughter and I lived in. Like literally at rock bottom. And I understood I had to work on me to deserve more in my life. So I became more valuable in life, started making a little bit more money, but then learned how money works.
Yep.
And then before I started doing all this crazy stuff, I learned infinite banking, and I'm telling you guys, I was losing sleep at night. I was watching your YouTube.
It's just so exciting.
I was watching your YouTube, Caleb's. I was watching Chris Nagel, reading books, articles, literally just packing my brain full of the knowledge. Yeah. And a lot of people say knowledge is power. It's complete BS. It's potential power. For it to be powerful, you have to implement it.
Use of knowledge.
Right?
Yeah,
so like if I learned all this stuff and never used it, never shared it with anybody, there's no power. Zero.
Yep.
But once I learned it and I started sharing it and using it, that's where the power's at.
I would say knowledge without execution is not power, it's burdensome. Right?
Ooh.
It's knowledge without power is actually because it's like, because before you knew it, it's like the 4 levels of awareness, right? Like you're unconsciously incompetent is one level, and then consciously incompetent, meaning you kind of are aware that you don't know what you don't know, right? Like unconsciously incompetent is you don't know what you don't know, right? Consciously incompetent means like, oh, I learned about this thing, infinite banking, but I don't understand it yet. And then what happens is you go into the level of competence where you become consciously competent. So you hit this phase where you're like, okay, infinite banking, I want to learn about this stuff. And you become consciously competent. And then what happens is you master it. And then you become unconsciously competent, where it's like you just know how to do this stuff in your sleep. If you become consciously aware of something and you're in that second phase where you're consciously incompetent, right? You know about it, but you're not executing, you're not doing anything with it. That is the most burdensome mindset and mental space and emotional space and spiritual space to be in, because you now are going to be filling yourself with judgment, and there's going to be shame, and there's going to be all these things because you have this awareness of this next level that you can hit. And if you don't go after and apply that to your life and try to execute and surround yourself with people that are going to help you hit that next level, man, like it's
so
rough.
true.
It's rough. And so that's why, I mean, honestly, guys, that's why we do these videos. That's why, like, Devin and I don't even work together. Like, technically, we just
met like 2 weeks ago, 3 weeks ago.
Right, but we do this because, we met literally in person a couple weeks ago. But, like, my whole mission is I don't care, like, about, like, if you want to work with him or if you want to work with my company. Like, that's not what this is about to me. What's about this to me, and we've been making this joke, this, like, dark versus light kind of thing. And it's one of those things where we believe and we know that this is one of the most powerful strategies in the world. And if everybody understood it and knew it, they'd implement it and the whole world would change. Like literally, if every single person was given one of these policies at 14 days old, because that's the earliest you can do it, the entire financial world would change. And that's what I believe. The problem is there's a lot of misinformation out there. And there's a lot of people misrepresenting the wrong products, trying to sell like Index Universal Life, trying to position those like they can do everything for everybody. The bottom line is nothing could be further from the truth. They're not going to be able to. It's actually putting you in more risk by going with a different product. This has to be a properly designed, properly structured, participating, mutually held company.
Yep.
And you got to work with somebody like Devin or somebody on my team that knows what they're doing. And there's no negotiating that. Like this is what's been done for hundreds of years at this point in time, right?
Yeah.
Like this has got the track record of success in doing this. But the bottom line is we need more people, and I'm just stoked to be doing this with you because we need more people sharing this information, because I think we have to have a mindset of abundance in this industry. I think we have to have a mindset of saying, listen, let's not try to fight over our little piece of the pie. Let's just make the pie bigger, right? Period.
I'm still in that one too.
So, I mean, but that's it. That's it. And so that's why we're doing this. So you're probably going to see more content from us because we actually live pretty close to each other.
Yeah.
He just drove down. We're doing this content today. But I'm super excited, dude. I'm stoked for you for your car. I got to drive this thing at some point in time. But
I'll take a deposit.
there you go. $40.
Just pull from your
There you
policy.
go. Exactly. So I mean, this is a lot of information, right? Like, I mean, this is we try to break it down. This is one of those things where this has to be a YouTube video because there's just too much information to pack into a reel or a TikTok or anything of that nature. And the bottom line is, I promise you, if you wrap your head around this and if you start implementing this in your life, I'm gonna challenge you as we get out of here and say you probably would self-admit that you need an emergency fund. You probably would self-admit that you'd like an opportunity fund to be able to prepare and to be able to do exactly what he's showing you here. This is what we're talking about, right? If you don't have an emergency fund, you're like most Americans, you need to start. This is the way to start. This is the place to start. Start executing now. Plant your tree today. Reach out. I'll put links in the description below on my channel. He'll do the same on his channel. We're going to put this on both channels. I'll tag him. You can go follow Devin on YouTube. If you're on his channel, come follow me, whatever you want to do. But I mean, it's really, really straightforward. It doesn't need to be complicated. We both have great teams. We're both happy to help you, give you clarity, no pressure. We just want to serve, and that's it.
Yeah, one last thing I'll say, guys, is this does seem really complex, but it's really not.
No,
like, it really isn't. Like, once you fully understand infinite banking, it's very simple.
Yeah.
All you're doing is you're just making a spread on money. That's it.
That's it.
If you borrow at 5 and you make 6, what's your spread?
Yeah.
1%.
Right. Yeah.
If you borrow at 5 and you make 10, what's your spread?
Yep.
5%.
Yep.
That's all it is.
Yep.
And you're just borrowing against your money that never stops compounding, so you get the cherry on top.
Yep.
And, oh, by the way, all the funds that you put in there protected against lawsuit and judgment in most states.
Yep.
Give not you, but your family
totally.
a tax-free benefit, life or death benefit.
Yeah, I just did a TikTok on that the other day.
Like,
yeah, it's totally. It's it.
It's not that difficult. And I will tell you this, guys, when I learned this stuff 2.5 years ago, if I would have saw this video, I'd been like, what? And I was learning all this stuff and really like cramming my brain with it. It wasn't until I actually got a policy and did it. It's like if you never rode a bike,
Right.
and I said, dude, hop on this thing, you're gonna sit on the seat, you're gonna grab these bars, put your feet on these little pads, and then put them in a circle and go and balance. You'd be like, wait, what?
What? Yeah, exactly.
But then you learn how to ride the bike.
Yeah.
You could not ride a bike for 15, 20 years.
You just hop on,
jump on one, do wheelies.
Yeah, totally.
It's like that, guys. Once you learn infinite banking, once you do it, it's easy. I literally dream about this stuff.
No, I know. I know. It's kind of weird. It is what it is. So here's the deal. If you have any questions at all, you can go down in the description below. You can click on a link. You can set up a call. You can just leave a comment. My wife always says I'm better at responding to YouTube comments than I am text messages. So go ahead and do that. If you haven't already, subscribe, hit the bell, that way you're notified. If you haven't already, go to his channel. Make sure you subscribe there. And that's it. Until next video, guys. Have a blessed, inspirational day. We'll talk soon.
Peace.
Later.